thank you so much. And hopefully, guys, we can go into that exam and know very well that we're passing. Remember, we said to ourselves, we're keeping a positive attitude to this, right? It will end in CASA. No matter how many subs, it will end in CASA. And this is the time when we're getting this exam. Thank you so much, Mnumzane Mdweshu. Do you mind jumping off? Okanye, you'll be continuing with this session, but what we'll do is we'll quickly send through your responses. And anyone who's just writing auditing who joined us, thank you so much. You can definitely exit. That will be the end of the intervention program for you. But whoever needs to continue probably writing text, we've got someone who's been working with you guys, and I'm sure you're aware of him. You've seen him in your classes. You've seen him whether online or in person. His name is Mzwanele Mdweshu, and or Mdweshu. You may please correct me on that. Say, I kept messing up his name. You'll see that on quite a number of the programs that we sent out. I kept saying Mzwandile or Mzwabantu. A lot of different people have different names for Mzwanele, and the reason for this is when I heard of him, someone called him Mzwa, and in my mind, what recorded was this gent is either Mzwabantu or Mzwandile. Now, when they told me that Mzwanele, I think it didn't quite record in my mind to say, oh, now I can just forget that he's not Mzwandile or Mzwabantu, and I think that continues. But Mnumzana, thank you so much for agreeing to do this. We really look forward to learning text with you. We really look forward to gaining from your understanding of your text, your expertise of text, and the work that we do. For anyone who's joining us for the first time, we just have a few housekeeping rules for someone who was in the auditing session. I'm sincerely sorry for this, but I'll go through that once again just quickly before Umhlekazi takes us through taxation. Be open-minded. A number of people could ask questions that you think are silly or stupid, or someone in this level of studying should know this thing. But if we're open-minded, we are going to be tolerant among each other. So when somebody asks a question that you feel like, no, you're supposed to know this, or whenever someone asks a question, you feel like I know the answer to this, still do listen and try to see if you can feel some gaps in your knowledge. Remain on mute unless you'd like to speak. Thank you to Abantu Tex, anyone who is Abantu Auditing. If you're here in Tex and you were there in auditing as well, I truly appreciate that you guys remained just on mute. We didn't get any disturbances. The session just moved smoothly. What we got was just texts of people who struggled to hear. Please do drop those in. Once again, should you be struggling to text, I do call. Anele can agree on this. I do call. I'll try and call you on the side just to see if you're facing some struggles or on your side, to see if we can try and assist each other. The sessions are recorded, so what we'll do is we'll try and upload them as soon as we reasonably can, and we'll share the link so that you guys can go back to some of the lessons, because we might miss some stuff. We don't have all the time. Use this as a learning opportunity. No matter how much you know about text, and no matter how less you feel you know about text, even if you feel like this is giving you trouble and you've got this negative attitude towards it, let's take this as a learning opportunity. Mnumzane Mdweshu is here for that. Let's ask all the questions that we'll need, and let this be that learning opportunity, that turning point for you in text. And remain faithful, hopeful, and confident. That is a rule. We don't take negativity here. It will end in CASA for each and every one of us. And for us to get to that CASA, we need the CTA. So at this point now, text is the barrier. Text is our problem. We need to change all of this 10 lemons into lemonade, they say, or turn these barriers into stepping stones. Let's use this as a learning opportunity. And those are pretty much the rules that we have. Mnumzane Mdweshu, are you on the call? Can you hear us? Are you happy to start the text yet?
Yes, Mhlekazi, I'm available. Sandy Corner, I'm ready to start.
Brilliant. All right,
whenever you're ready, I'm ready as well.
All right, God.
Yeah, the corner.
Number one. No, that's lovely.
Everyone is okay.
Yes. Yes, sir. So let's get our slides up. Let's get the stuff that you'll be working on up.
Okay.
And we can start working on text.
Okay, let me just work on that. Let me see how I can project. Just tell me if you can see something on your side. Not sure.
Yes, now we can see.
It's projecting.
Yes, sir.
Okay. Thank you very much. Is there anything else you still want to cover, or should I just go in now?
At this point, yeah, I think the floor is definitely yours. Should there be any comments or questions or anything of that sort, we will definitely just raise those as we go.
Okay. Okay. Good evening, everybody. As you already know, and Mzwanele, I'm sure you know me, guys. There's no need for me to do a introduction, and we're just gonna be looking at the text. Okay, yeah, we're just gonna be looking at the text there. First of all, before see congratulations, guys, for you to make it to this far. I mean, like in the economy, boom there, and there were a lot of uncertainties. But getting to this point and getting us up, to me, it's a big step, because I feel like when it means you know something, yeah, but and most of all, if you have a sub, I feel like you must, even if it's one sub, that is still a good thing, because now it means you know what is happening with the other one, or the other two, or the other three. So what nobody's happy sub on us. So at this point, and now I think if the confidence, yeah, I try by all means, we win a level. I would say if we were trying to bring down the elephant. For Unyaga Wonke, we were trying to bring down the elephant. Now, whether now the elephant is selling millions or one and selling millions and maybe no money millions and you give it all your best. That is why I wrote there, do not let the elephant get back up. So at this point, do not let the elephant get back up, because I'm pretty sure now, njengoba unesapho ye-tax, whether it takes your okanye it takes nenye module, but you know what is you. I mean, like, it's a given. The other module you passed it, so it means give it your all. Kule tax, and it takes is one of the modules that you can pass, and I'm pretty sure. For the fact that you were able to get us up, because I think it's up is like a 45%. Oh, another thing, good people, I'm unable to see the screen. It's a Teams, because now I'm projecting. So if there's anything, please just unmute yourself and then talk. I'm cool with that. Okay. So I'm saying now that on the text and you were able to get a 45% on your sub, it means you know something. Okay. So at this point, it's about now finishing it off, and don't let it get up again. You're gonna make it on text, really. Okay, but though we see in a situation, I mean, like, we do have a problem. That is one thing. As you see, a corner into enemy as you face, which is time. It's the biggest enemy that we are currently facing. So I can tell, and I know that you guys do not have much time. Your result is coming, and then like you have to get everything together and prepare for Monday, Tuesday, Wednesday, Thursday. So that is understandable. But does that mean now throw everything down and say, okay, that's it? No. We just have to find a way, to work around your your timing. Try to fit everything in, so that when that day comes, you are ready and to get on the back and fight. Okay. So yeah. And another thing that I've also done here is that I've just prepared the slides. The reason I didn't want you to do a specific question, guys, is because I feel like with the time against us, saying that you must prepare a certain question, that was just gonna waste our time. Yeah, but so we won't be able to cover everything. So here, what I'm gonna be doing, and I really wish that you could have like a sort of a pen and a note, where we just going through each of these chapters, just browsing in each of these chapters on text. My intention is to jog your memory, just to you save your time I mean, you can tell at the back of your mind to say, okay, I feel like I'm more comfortable with this chapter, so it's pointless for me to spend more time on this chapter, so I'd rather focus on another chapter that I feel like I'm not comfortable with. So that is like what I'm trying to achieve at the end of this session, to say that by the end, now you are at a point where you know what you are comfortable with, you know what you're not comfortable with. So you know what to focus on and what not. Okay. So that is like my objective. Let me not waste time and just get into this. If you don't see my slides or something happens, please don't hesitate to tell me. Okay, because I'm just gonna be moving from one chapter to the next. And if you have any questions, you just unmute and talk. Okay, my wish is that we talk back and forth. We just engage. Okay. First of all, let's just talk about VAT. I mean, VAT. Okay, I feel like before I talk about the VAT, so what happens is that on tax, the type of questions you usually have is like discuss, calculate, discuss with the aid of calculation, or calculate with brief reasoning. So it's those 4 questions that you would usually come across in tax. Now, you need to know, firstly, before you start answering, you need to know what do they want from you, because I feel like that is the one thing that makes us fail tax, really, because most people, they will tell you that they know tax, but the marks they're getting, do not reflect the knowledge they have on tax. I feel like we're just missing out on those things, and also on writing everything. We're just going to be talking about that as we go through the slides. Write everything, even the things that you feel like they are very, 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 very obvious. They're so obvious. Put it down. Okay. Now, when we're talking about VAT, obviously, if it's a discussion question and then, you ask to discuss a supply, obviously, you're going to have to touch on time and the value of a supply. You just know it. If you do not touch on those, obviously, you're leaving some marks, because these are the easy marks that at the back of your mind, you'll be thinking, no, I've actually covered this. If I say this is a taxable supply and the tax that is going to be charged on this is this much, but you left out some marks to say that when is the time of supply and the value of the supply and so on. Whether and after before going to say, okay, this is a zero rated supply or an exempt supply. So it's just those things. And one thing that you gotta look out for is the deemed supply. I feel like you know how you should treat those. Talking about the deemed supply, ceasing to be a vendor. What happens when you cease to be a vendor? You deem to have supplied the goods. Okay, then output VAT kicks in to say that in terms of section 7, paragraph A, section 7, subsection 1, paragraph A, this is what is going to happen. Okay, this is a taxable supply. The going concern and the indemnities, the insurances, when they pay, that is also a supply. And then when you're delivering goods outside the Republic, if you have branches, that is a supply. And you know that what VAT consequences apply in each of these supply. And also now the leasehold improvement. I don't know if you remember that. I think it's section 8, subsection 29, when they're talking about the improvements. That if it happens, that the lessee now effect improvements on the asset they're renting, and then now the lessor did not require the lessee to do the improvements, and then they're not getting paid. In terms of section 10, I'm not sure about the subsection. They say that is the value of the supply now is deemed to be 0. But in terms of section 829, that is also deemed as a taxable supply. Just make note of that so that you go and look at it and be happy with that. And then the financial services, exempt supply, the second-hand goods. What happens when you buy a second-hand good? Okay, remember now, when you buy a second-hand good from a non-vendor, it wouldn't have VAT on it. So what happens? Remember now, in that situation, that asset, you claim the VAT at the lower of the consideration paid and the market value. So you just gotta keep in mind of those things. Be very mindful when you see those things. I'm just joking your memory, guys. And in import of goods or services, when now you have to please tell me if I'm moving too fast, but I'm also worried about time. I don't want to keep you here because I understand that you don't have much time given that on Monday you're writing. So okay. And also adjustment, section 18.1, when you're talking about the asset decrease, a decrease in use of the asset. If it was 100% used for vegetable supplies, and then now you're no longer using it for that purpose. And then subsection 2, it is also a decrease, but now a partial decrease. when do we deem the supply to have happened at that point when something like that happens? Okay. And then subsection 4 and subsection 5, the increases. Okay. So remember, and always and remember again, on I think it's subsection 2, when there is a decrease, you know, if it is subsection 2 and subsection 4, decrease, a partial movement. Let me just say a partial movement. If now it is below 10%, that we don't do anything, and then the timing of that the event is at the end of the year in both situations. Okay, you just gotta keep those in mind, but just take note of that. Okay, I can also make these available to you so that you know they just remind you what to look at. And then the fringe benefit in like section 8, subsection 3, you know, the right of use of motor vehicle, there is VAT consequences there, if you remember, 0.6% if the vehicle, if now the vehicle, or if the fringe benefit is subject to VAT, and at 0.3 if it's not. Okay, and then the 85 rands where you decrease the value if the car is under the maintenance service. Okay, just gotta remember those things, and the entertainment and the motor cars. So I'm just jogging your memory. You remember with the entertainment, the VAT vendor cannot claim input VAT because it's an entertainment. Section 17, subsection 2. Okay, and then on the motor cars, motor car is defined. In section 1, the motor car is defined there. So you gotta be careful with those and don't try not to miss them. And guys, in all what I'm talking about here is that in all of them, you have to make sure that you address everything, the time of the supply and the value of the supply. Make sure you address that. This is not a motor vehicle as defined. This is a motor vehicle as defined. Therefore, this is what is happening. Okay. So you write every information that you have to write, everything, put it down. Okay. And another thing, just quickly moving to the deceased estate and the estate duty. When we're talking about the deceased estate, you know, you know that we're talking about a person who has died. Okay. So if you are reading the question, when you are reading the question, and the moment you see the moment the question says that so and so died at this date, you already know from that point or in your mind that during your reading time, you already know there is a probability that the deceased estate is going to come out here, or estate duty. Because once they start listing the asset the person had before they died, you know, okay, estate duty might come in. The person has died, okay, deceased estate will come in. Okay, so the one thing that is nice with the deceased estate is that the way you calculate the tax there, it is similar as when you're calculating individual. I think we're still gonna talk about individuals on the other slides. Okay, but my point is now the calculation is the same, except that, you know, the medical aid contributions and the rebates, you know, those do not really apply on the deceased estate. Otherwise, everything would be the same. I don't know if I'm leaving anything else out that would be different. If I'm leaving something out, please do remind me. But, you know, so that we all remind each other in this situation. But it's the same, it's, you know, same calculation. Okay. And remember to apportion the rebates. Remember, your rebates are based on annual amounts. So if the person dies halfway during the year, so you know that you have to, you know, apportion those rebates. Okay. Based on the month at which you are calculating the tax for that person. Okay. Okay, and another thing, I don't know if I mentioned this. Okay, the capital gains. Yes, I think I mentioned that the capital gains tax is likely to kick in. Remember, in section 9 cap A, if now the person dies, we deem that person to have disposed all of their assets. Okay, we deem the person to have disposed of all of their assets. Then now the capital gain CGT will kick in. Then this guy or that person would be deemed to have sold those assets at market value, and then we calculate CGT. Okay, and then be watchful of the assets that are given to the surviving spouse, because those ones, then the rollover provisions will then apply. And then the annual exclusion. We're going to talk about this when we get to CGT, but you know, I just thought I thought I should mention this also here. The annual exclusion, that it goes to 300 from the 40,000 to the 300 if the person dies during the year. Okay, you gotta be mindful of that. And
Sorry,
another thing to point out that is very important is the retirement lump sum. So anything that is on the second schedule or the severance benefit, if you remember. So these, even they are, you remember that these are texted on different text tables. Okay, now the person is deemed to have received those on the date they died. Okay, that means that even if the person dies in August and then these amounts are paid in like September or October, when you do the tax calculation, you deem these amounts to have been received before this person died or on the date this person died. So you still include them in the calculation, in the tax calculation of that individual, not the deceased estate. Just note that. Okay. And then when you are doing the estate duty, I didn't write much about it because I feel like on the estate duty, there isn't much, you know, other than bringing, you know, the asset the person owned on the date they died. Bring those according to the estate duty. Okay. And then obviously after that, to calculate the duty-shaped amount, you have to take the amounts, there's like the amounts that are excluded. I think it's subsection 3, if I'm not making a mistake. It's not 4. You know, you got you take in the other amounts out, like the like assets, the amount of I mean the assets that are left to the surviving spouse is one of the things that you will be taking out. You see?
Can you hear me, Putiwalakan?
Hello?
Hi, can you hear me?
Yes. Yes.
Oh, sorry. My bad. I was already starting to think I'm losing my mind because I've been unmuting. There was a hand. I'm not sure if Apelele, you got sorted on that. There was a hand that you had probably.
Apelele, come in.
Okay, was it a mistake?
No, it wasn't a mistake. I actually had a question. Yeah. So Mzwanele, when we are doing the deceased estates, right? The retirement lump sums and the severance benefits, do we include these in the calculation of a taxable income for the individual before death, or do we include them in the deceased estate?
Okay, we're saying that these are deemed to have been received on the date this person died. Okay, so it means everything that has happened on the day up to the date this person died must be included. So this also includes the retirement lump sums and severance benefits. So you include them on the tax calculation of the person who died. So we treat it as if it was received by this person before they died.
Oh, okay, got it. Thank you so much.
Okay, awesome. Thank you. That was a nice question. Okay.
And I'm just thinking when I'm Mzwanele Mdweshu, before you remember we have that 15 minutes that we banked on. If possible, during some time in your lessons, do you mind just giving us a 5-minute break? I'm just thinking. Yeah, we may have jumped immediately from auditing. You were here, so you may have jumped immediately from auditing and came straight up Agutech. So just but when Mhlambe you've wrapped up what you need to chat on, it's 1938 now, so we still do have time. Just some 5 minutes when you see fit, ne?
Okay. Thanks, you know, I was thinking, I don't know what happened in my mind because I had that in my mind before I started the session. I think
yes, sir. Yeah, no stress. Ila passion, yeah. Yes, sir.
Okay, I'll do that, not a problem. Okay.
Thanks a lot, Puti.
Okay. I think yeah, I was still saying you have to reduce, you know, the amount of or the what are these, confirming something on the the value now of the estate with the amounts that should be excluded, and I was making an example with the assets that are left to the surviving spouse, that now those ones will be taking out and so on, you know, the exclusions. the exclusion, I'm trying to confirm the section that it takes out some properties. Oh, it's section 4. Then in terms of section 4, then you're taking out some of, you excluding some of the properties they based on section 4. That is like before now you reduce with the amount, the justiciable amount. To calculate the justiciable amount, you reduce with the 3.5 million. Okay, to get to your justiciable amount. Okay, but on the estate duty, I really feel like this is where you should be scoring marks, because if it comes out, what you're gonna be doing is that you're bringing in what you see in front of you. You know, and one thing you should note is that if it happens that, you know, on the day this person died, the asset got sold and the market value of you have like the market value of the asset, and then you have the amount at which that asset it was sold. So in those two situations, the amount that you take is the amount at which that asset was sold, not the market value. Just be mindful of that. Okay, keep that in mind. You know, I always had a confusion thinking that, you know, it is the market value, and then when I looked at it, I think in section 5, they're gonna tell you that no, you take the amount at which the asset is sold. Okay, so be careful on that. Trying to think if there is something I'm leaving out here. Also, the other expenses, you know, of dissolving the estate of the person, then you gotta take those out. But really, here is just, you know, plugging in and then taking out what needs to be taken out, and then you get to the justiciable amount, and then, you know, you do your things, you do the calculation. Okay. Guys, let me just give you the break now, so that, because I need your fresh mind. I need your fresh minds. We're gonna come back at 7:45. Just a 5 minutes break, guys. I need your fresh minds, because it will just be pointless if yeah, I don't have your fresh minds. I had this, you know, before I started the session. I don't know what happened.
Yeah, it's already 7:42 now on my side. So if we give a 5-minute break, that would be 7:47.
Okay.
All right, cool. Returning. I'll just write that on the text. Quickly get something to drink, quickly get something to eat, or probably just take a walk, a quick one. It's going to be a 5-minute one. So we're coming back at 47. Yes. All right. I think it just hit 1947 on my side. I did have a bit of a brain freeze after declaring break into about, oh my, where do I start? What do I do in 5 minutes? And I hope that that wasn't the case for our colleagues on the call, and that we managed to do something in that 5 minutes. It was indeed short. Yeah, I think we can take it from here, Mr.
Okay, thank you. I don't know what was that. Okay, thank you. I hope everyone is back. Let's just kick on. Okay, now let's just quickly talk about the trust and donations. Okay, when we're talking about the trust, I'm not gonna go on to define what a trust is and the types of trust, but you know what happens in the trust. Is that now the trust will have the trustees and the beneficiaries. Okay. And then now in terms of what is this? I think it's section 25 cap B. Okay. And then now section 25 cap B is I think it's a section that deals with the trust. Let me just confirm that quickly. It's the section that deals with the trust. Yes. So in terms of, yeah, that's correct. In terms of now, how is the trust taxed? How is the income received by the trust taxed? Okay. And if you look at subsection 1 and subsection 2, it tells you that, if now the income that is received by the trust is now vesting to the beneficiaries immediately. It is vesting to the beneficiaries, meaning that it accrues to the beneficiaries. The beneficiaries can have that income at any time. Okay, then that income is taxed on the heads of the beneficiaries. Okay, and then if now the income is now held by the trust, not vested on the beneficiaries, then that income is gonna be taxed on the trust. Okay, that is like the general situation of the trust. Okay, but now what happens is that in the test, it is not usually as straightforward as like that. You're gonna, there's gonna be some spices here and there, just to see flames, or people to have like a sort of a taste. Our lecturers, they're gonna put the spoon on the microwave just to see some flames there. Yeah, but then they bring in some donation, say that, okay, someone donates the asset, donates the building, or donates the building, or sells the building to the trust on credit. Okay, then it means that now the trust is going to be paying interest on the loan that is outstanding to that person. Okay, or the trust, it happens that it doesn't pay the interest to that person. Okay, then I think that is now section 8. That would be section 8 cap C, where now the trust is not paying section 7 cap C. Sorry about that. It is section 7 cap C, when now the trust is not paying the interest to the person that it owes. If now the person sold, let's just say, a building to that trust, and then this person says that, okay, now don't pay the interest. Okay, so we still regard that as now a donation. Okay, so that's what happens in that situation. Or now the person just donates the building itself, okay, to the trust.
And I'm thinking of something else they would also give to the trust.
So I said it's a building or it's an investment. If they have an investment interest, then they give that investment to the trust at no payment. So they just donate that. So in those situations, then you gotta worry about Section 7. Section 7, remember, is one of the anti-avoidance sections. So where people, because I think this section comes in because now you see the rich people, they'll be getting taxed at the maximum bracket. So in a way to reduce their tax, they just take their assets and then give the assets to the trust. And then they make their kids or their children the beneficiaries of the trust. So that, you know, the money is not taxed on them and then it is taxed on the kids or their relatives. So they just make those people the beneficiaries of the trust. Okay. Then in that way, they're trying to move away from the maximum bracket, trying to move away from being taxed on the maximum bracket to a lower bracket. So I think now that's when our Section 7 comes in to say that, okay, now let's put you know, our eyes and look at this. What is happening here? Let's put some glasses on this. Okay, now you have a situation. Let's just take a first situation when now the income is vesting to the beneficiary. Okay, and now we gotta look at, okay, the income, that means the beneficiary can have the income at any time. But note, when we look at this, there must have been a donation, settlement, or other disposition in terms of Section 7 to say that, okay, let us look at this closely. Le mali ifunyenwe from the trustee, okay. And then we're going to be talking about now the minor. If the amount is received by the minor, please note in this situation, in Section 7.3, it talks about the minor. But when it talks about the income that is received by the child, so the donation must have been made by the parent of the child, not the grandfather, not the uncle, not the aunt, but specifically the parent. Sometimes, you know, the lecturer will trick you to say, okay, the person who's made a donation is the father, is the grandfather, you see. Then in that situation, you would want to say, yeah, I feel like Section 7.3 applies here because this person is a minor, okay? But you gotta be very careful with that. If now the donation was made by the parent of that child, then that's when Section 7.3 applies to say that, okay, this income is not gonna be taxed on this child, whether it was that interest that was not paid by the trust, or it is the interest that is okay, that the interest will be from the sale of the property, whether it's the dividends, the income from, the donation of that investment to the trust. Now the dividend is paid out and then the dividends accrue to the minor. Then we revert that dividend paid to the donor, which in this case, a parent. I don't know if you get what I'm saying. I really hope you do, though. Okay. So if the income is received by the minor from the trust, whether now it is vesting or it is distributed by the trustees, but once it goes to the minor and there was a donation, settlement, or other disposition by the parent of that minor, then we revert it back. And then another situation is that now, if now the income is received by a non-resident, we look at it from which source this income comes from. So is it the rent from that property that was donated, or is the investment donate to the trust? Okay, and then this person receiving is a non-resident, then we revert it back to the donor. Okay, and then now Section 7.5 deals with the situation where that income is kept by the trust, because Section 8 and subsection 8 and subsection 3 deals with the income that is now distributed. What happens now if the income is not distributed? It is kept by the trust until, you know, something happens or until someone decides to distribute that. Even that one, we want that one. If it is from the donation, settlement, or other disposition, we want that income as well. It must revert back to the donor. The only income that is going to remain on the trust is the income it takes. Okay. So in that situation, then that income will be taxed on the trust. But if now the issue is that there is a donation somewhere, there is a donation, or the building is donated to the trust, then the rent income from the building will revert back to the donor. Whether the rent is distributed to the minor, distributed to the non-resident, or it is not distributed at all, it means that it is not vesting at all, then it will revert back to the donor. So you gotta take note of that. Should there be a donation in the trust, then that is the situation you're likely to come across. Okay, I hope you're making some note, and that is jogging some things in your memory. Okay, just put something down and you go and look at it, just to make sure. Also, go and look at that section 7 cap C. Remember that section 7 cap C, the donation on the interest. If now it happens that the trust is not paying the interest. Okay. And then now let us talk about the CGT, allowances, the recoupment, and so on. You know, these usually go together. Okay. Yeah, that's why I just decided to put them, you know, in one place, because I feel like all of these, they just go together. I mean, like from the day to buy the asset. And by the way, section 24 cap I, and also section 25 cap D, the conversion of the, once you have like the section 24 cap I, there's no way you're not going to section 25 cap D, where now you're converting the value of that asset from the foreign currency to the local currency. Section 25 cap D, you're always gonna have that. And you have to mention that. Buffeto, you have to mention that. You have to say that. You have to write that section 25D, because your mark is there. Don't just convert. Convert and say section 25 cap D, because you have to show that you know that this is convicted according to this section, and it must be convicted. And secondly, when that asset is purchased, always remember, you need, because there's like these tiny marks that we don't say. We don't take. Like for instance, once that capital asset is purchased, let's take a machine for instance. That machine is purchased on that date, you converted section 25 cap D. You need to say that this value of this machine is not deductible in section 11A. Remember, section 11A doesn't allow deductions that are capital in nature. Okay, so you need to mention in this in your answer sheet that this is not deductible in section 11A because it's capital in nature. And go forward to say, however, it will receive allowances based on section 12 cap E, 12 cap C. Okay, depending on what you are dealing with, whether you're dealing with a small business corporation or you're just dealing with a normal business. So by mentioning that, I feel like you already have 2 marks there, because by mentioning it's not deductible in section 11A, it's capital in nature, you have a mark. And another mark to say that this is the section that will apply before you start even doing the allowances. Okay, and take note, it's not like in accounting, once the machine is purchased and ready for use, then you start depreciating. You don't give the machine the allowances until it is brought into use. I think it is like that in most of the allowances, capital allowances, capital asset allowances. Okay. It is like that. The machine must be brought into use. It happens that, in most cases, they would have the machine. They would buy the machine. Then what happens? They buy the machine and then the machine gets destroyed. And then once the machine gets destroyed, then the insurance pays. Okay, the first thing in the situation like that is that you're already thinking of a rollover provision, because the machine was destroyed and then the insurance paid. Then in that situation, whatever capital gain you're getting, whatever recoupment you're getting, you're not gonna include it on your gross income. You're not gonna do that. You're gonna do the calculation, but once you're done with the calculation, you're gonna say paragraph so and so is not gonna apply. I forgot the paragraph. I think it's around paragraph 60 something of the A schedule. Okay, but the rollover provisions, I think it's 54. But you need to, do that calculation and mention that, okay, this is what is happening. You're not going to include it because this person would like to reduce their tax as much as they can. Okay. Just confirming. Oh, yes, paragraph 65, the rollovers. Okay. You need to do the calculation and do the rollover. And then from there, after you've done that calculation and then you don't include those amounts, then the scenario goes on to say that, okay, then they had to replace the machine. Then they replace the machine immediately. Within that year of assessment. They replaced the machine, but now they replaced the machine with 2 machines, not with 1, with 2 machines. Okay, fine. You are happy with that. How now you're distributing the capital gains and the recoupment between the 2 machines is based on the amount that was paid by the insurer. Okay, how it was spent on this machine. If the insurer paid 100,000 and then the 70,000 was spent on machine A, 30,000 was spent on machine B, you're gonna split that recoupment based on those ratios, 70-30. That's how you split it. Okay. And then now you have the second asset. What happens is that the other machine is brought into use in the current year. The other one is not brought into use in the current year because there's some parts that they're waiting for, and then they're going to bring it into use in the following year. You have to be very careful in that situation to say, don't give the other machine the allowances until it is brought into use. And remember also, I think in section 24I, subsection 7, in that situation, even in that situation, you do not, section 24I, let me just say that you don't give that the exchange difference that you would get on the amount that you owe if it happens that the machine was purchased on credit. The exchange difference, you don't deduct it at that point. Remember that you don't deduct it until the machine is brought into use. I think it's subsection 7 in section 24I. Okay,
I like this, Mshakazi, and I need you to please emphasize that, because when we look at the brought into use, we just look at it from a capital allowances or wear and tear perspective. And when it comes to these exchange differences, I know personally I would forget it. So it applies here as well, that we can't have those exchange losses if we have them there as a deduction from someone's taxable income if that asset that was bought from a foreign supplier is still not yet brought into use.
Yeah, it's very easy to forget that. Actually, most of the time, it will get people. They just easily forget that those exchange differences, you cannot deduct them until the machine is brought into use. Okay, just be mindful of that. Okay. What else? Okay, now you have your machine, you're claiming your allowance, using the machine, you brought the machine into use, when the machine, it is receiving allowances. Okay. Well, in section 12 cap C, section 13.1, section 13 queen and so on. Okay, how you're doing your allowances. I'm not gonna go through that. But until now it gets to the date that the asset is sold. I think I've already spoken about that. We calculate your CGT, and then be mindful if now the machine is sold to a spouse, or I think the rollover provisions. I think I already spoke about that. I said the paragraph 65, when the machine is damaged, and then now they're gonna replace that machine. Okay, and then the primary residency, yes. And if you guys remember this one point, there was like this situation where a person was staying on the boat. This person had everything on the boat, so he didn't have any other place he was living on other than that boat. He was a fisherman, you see. Then you gotta be happy with the definition of a primary resident, because if that person is staying there and this person has everything in that boat, that becomes their primary residence. Once they sell their asset, that boat, then they can now claim, the primary resident exclusion. Okay, and then the personal use asset. Remember the personal use, the loss made, the gains made, and the losses made on the personal use asset. Those ones that get disregarded. Just be mindful of those. And then the sales to connecting persons, I think it's paragraph, that would be paragraph 37. I'm not quite sure. But when you're selling something to a connected person, it depends now if you have sold it at a market value or below the market value. Because if you sell it at a below market value or at no consideration at all, then now we apply the market value. Assume that you sold that at market value. Okay. And the treatment there in the acquisition and disposal at different currencies, that applies differently between the natural person and also companies. Remember that. I think that is on, let me just confirm a section on that, because I'm not gonna go deep on it, so that you go and look at it at your time. Okay, sorry, but on connected persons, it's not paragraph 37, it's paragraph 38. I just confirmed that. Okay, I'm just still looking at okay, that is like paragraph 43, the acquisition and disposal at different currencies, paragraph 43, because now there's like different way. If now the asset is purchased in the same currency, like in dollars, and then you also sell it in dollars, how do you go about that, calculating the CGT if it's a natural person? And then if now it is purchased and sold at different currencies, then how do you go about doing the calculation on a human being or on a company? There's like different treatment there. You need to take note of that and go and look at it. I'm not going to go in because it would just take me, more time. Okay.
Yes, sir. Then, just a quick one from Sianda there. When a second-hand manufacturing machine has been purchased from a non-vendor, do we calculate the allowance deduction based on the cost less notional input deduction or the cost?
It is the cost. You have to remember that. I don't know if I get your question right. You're saying that basically, because remember on VAT, when you're doing the notional, when you're calculating the notional VAT, it is the lesser of the two, right? The market value and the consideration paid. But then now when you're claiming, so what happens is that now you claimed VAT on that, but when you come back to this side, when you come back to this side to claim the allowances, you cannot claim on the market value. I'm trying to think which one is lesser now. You're saying if now it happens that the consideration you paid is below the market value, then you're going to claim on the consideration. Then it's not going to be a problem when you come to this side and doing the allowances, because you have to remove the VAT on that amount that you paid. Okay. And then if it was the market value that you claimed, you're going to claim your input VAT. And then when you come back to this side, that's what you take, but you still use the consideration that you paid. And depending now on the section, on the section that you are dealing with, because it is on the consideration that you paid. I'm trying to see section 12 cap C.
Sianda, on your side there, are you sorted? Is it is the answer giving an idea that the question is understood? Is that what you were asking? Are you at least with us here? Are we at least answering your question? Just kindly confirm that while we still look. Mzwanele Mdweshu. Are you there, Sianda?
Yeah, but in that situation, you claim it on an amount that you would have paid. The consideration, unless I'm trying to see if section 12 and cost to the display.
Okay, while we still look, I think Isandla Spusu is up. Spusu?
Okay, Spusu, you may come in.
Yes, I just wanted maybe to ask if I'm getting this question, maybe explain it a bit better. So I think what Tianda is trying to ask is that if you have a second-hand machinery, so when you're trying to calculate your allowance, do you use so in when you take the cost, you have to deduct the VAT. So she's asking, is it the cost less the VAT or just the cost itself, because it's a second-hand manufacturing machine?
Okay.
Because of that requirement of having to take out VAT from if the amount is inclusive of VAT, of course. I don't know if makes better.
Yeah, I think that makes sense. But remember, you cannot get deduction twice. I think that in terms of section 23, a cap A or cap B, but you cannot get deduction twice. So obviously you're gonna have to take out VAT, because now that input tax has already been claimed. So you cannot claim twice.
Okay. I don't know, Sianda, if
that covers
that
your
then answers it.
Yeah, it's section 23 cap B, provision of double deduction.
Right. Thanks a lot for that, you guys. I think Ustianda texted there as well. Unless there's any other additional points that you'd like to say, Sianda, you're definitely welcome to unmute or chat on the chat box. But Ubalile, that yes, I think I am sorted on that. Best believe, Mzwanele, we are left with about 4 minutes. But yeah, it's very sad. It's very sad. But we can, I don't know, at the discretion of the team, probably add that other 5 minutes that we took as a break, just to run through the remainder of the stuff. And obviously, no pressure intended. If we can't get through some important parts, I think we can share the stuff with the team, huh?
Yeah, I can share the slides, you know, because I feel like, you know, it can jog some things in their memory, and then they can be able to go back and look at those things.
Yes, sir. Yes, sir.
Okay. All right. Yeah. Okay. I'm happy, Sianda, you started. And you know, I think mostly it depends on what the section requires to you to do a deduction on. I mean, like if the section requires you to do the deduction on market value, then you use the market value. But if it requires you to do the deduction on a cost, because section 12 cap C will say 20% of the cost, you understand? Then you see, but the amount that you would have deducted in the amount of VAT, you still take it out. You don't deduct it twice. Okay. And then the small business assets, when now the person is selling their shareholding in a small business asset. That is like paragraph 57. You go and look at that. Okay. Just note it and go look at it. Okay. And then let us just quickly jump into leases. You know, leases can seem to be complicated, but you know, I feel like if you have a sort of a structure in terms of how it goes, you just have in your inception, at inception date, lease period, and then a termination date, and then you know what happens in each of those dates. Because remember, you have to know what happens on the lessee and then on the lessor side. Okay, you know, at inception, there's likely to be premiums, lease premiums, like getting paid at that date. And then what happens to the lessor? What happens to the lessee? What now reliefs do these two people get? Okay, and then and also deductions. Okay, and then over the lease period, you gotta take your marks on your rent payment. Okay, sometimes the examiners, what way they will do is that they will give you a lease that started in 2017. And it is ending in the current year, and it ends halfway during the current year. So they want to see, so in a situation like that, it's when now they're gonna bring in the recoupments. Okay, that is section 8.4. They bring in the recoupments if now they ended in the current year. That's where now the machine there's like a lot, there's a lot that is happening that could happen, because the machine can be given to the lessee at a lower amount. The machine can just be given to the lessee free of charge, you know, or the lessor can just abandon the machine. So in that situation, you gotta be careful with that. Okay. And another thing that I wanted to emphasize on mostly is the improvement. Usually the improvements get done after the inception period. Let's just say now your lease period is like 30 years. And then 3 years later, the person was, you know, based on the lease on the lease agreement, this person was required to construct a building that is worth like you know, let's just say 5 million. Okay, and then this person, based on the contract, is required to spend 5 million. This person spends more than 5 million. Just say this person spends 7 million. Okay, you know, they can only deduct the 5 million that is according to the contract. You have to remember that. Okay, they can only deduct the amount that is on the contract. The remaining 2 million, they can, depending on what the building is used on, because some section, I think it's section 13.1 or section 13 Queen, I'm not quite sure, but if the section doesn't require the person or the taxpayer to own that particular asset, then that person can go to that section. I think it's section 13.1 and section 13 Queen. You're not required to own the building. So if you are not required to own the building, you can still go to this other section and claim on those sections. Okay, let me just come back. to say now, over which period do I then now claim the allowances, the improvements on the allowances? Okay, remember that you are limited to 25 years. But now what happens is that you are at the remaining lease period is like 23. Let's just say it's 23 years. It was 30 years at inception date. Now it is the remaining period is like 23 years. Over which period do you deduct the lease improvement? The remaining lease period, which is like the 23 years. Okay, because this is what is remaining and it's below 25 years. If the remaining period was 27, then you were going to be limited to 25. Just keep that in mind. And also the VAT on leases, remember what we spoke about when we said that there is like the value of the improvement is deemed to be 0. So, Mhlekazi, please do stop me if
yes, sir. No stress at all. I think you've just tapped into the remaining 5 minutes of our time, so we probably left with about 3 minutes now. So I'll definitely let you know.
Okay. And then now this is the interesting one, guys. These marks are just a take-home marks. They might seem as zinzim, but you just have to find a way. Structure. They have a structure in terms of how you should go about discussing tax avoidance questions. They are discussion. I don't remember ever coming across a calculation tax avoidance question. Most of they just discussion. So how do you discuss? If you're talking about the section 8 cap A to L, impermissible avoidance arrangement, you know that you have to define the arrangement. What is an arrangement? The arrangement is defined in I think in section 80 cap L, and then avoidance arrangement. You have to define that. The tax benefit, you have to define that. You have marks on those things, mentioning that and applying that particular section. Okay, and then any other paragraphs in those paragraphs, because those paragraphs they say or. So any of those paragraphs that you feel like they apply, then you bring them in. And then after that, what you were trying to achieve, you were trying to say this is an impermissible avoidance arrangement because it is an arrangement. It is an avoidance arrangement. It has a tax benefit, and then it lacks commercial substance or whatnot. You see. And then after you've concluded that this is an impermissible avoidance arrangement, you can then go on to say that then the tax consequences are going to be this and that. Okay, you go and look at that. Otherwise, this is how you discuss it. Same applies to section 31. Section 31 is very sneaky because most of the time people would miss it. But I just want to, I'm talking about section 103, not section 31. Even section 31 is sneaky as well. I feel like these two, they're just sneaky. You wouldn't see them. Let us
tax
just talk
itself is just sneaky. Why tax is sneaky on its own.
Yeah. So it's very easy to miss, these questions. But the moment you see that there is an income, there is a change in shareholding, and there is an assessed loss involved, just watch out, because there's gotta be an assessed loss involved. There's gotta be a change in shareholding. And then the only thing that you're looking out for is the income. Okay, somebody paid another person. Obviously, 103 applies. And then when it comes to section 31, now we're dealing with the transaction between connected people. Where now they're trying to avoid to run away from tax, and then the other person is a non-resident. Just watch out for those connected persons that the other one is a non-resident. It's a connected person and the other one of those people is a non-resident, then okay, I suspect section 31 will come in. Obviously, in the assessed loss, section 20, the reinforcing might also come in, but you also gotta be watchful of 103, the anti-avoidance section might come in. I'm just telling you about the triggers of these questions. Watch out for those things. Okay. And then we're talking about the special corporate rules. This is a relief section to the companies and the person acquiring shares in the companies. They're just given a relief. But for that relief to apply, because this applies at an option of those people involved in that transaction. You see, they decide to take it or not. I think they would take it because it is a relief. Because we then say that there's not going to be CGT consequences, there's not going to be recoupment. We deem this person to have acquired this, we deem the company to have acquired the asset at the same date as it was acquired by the person giving the asset in exchange for shares. but there's like these requirements in section 42. When you do a discussion in that question, you have to tap in those discussions to say, okay, the market value of this asset is above the cost. So if this asset was sold, there was going to be a capital gain, or there was going to be a zero. There was not going to be a capital loss. And then this person is holding a qualifying interest in this company, or this person is going to be a full-time employee of that company at the end of that date. Therefore, this is an asset for a share transaction. You conclude, and then you say from there, it's more like this one. You just firstly discuss you firstly qualify it. Once you qualify it, and then you go on to discuss the tax consequences from that point. You say that, okay, this is what happens. This person deems to have acquired these shares and this asset at the same date as it was acquired by the other person, and so on. Okay. Same applies in section 45. Section 45 is not that different in section 42. It's just that now we're talking about the intergroup transaction. And for you to discuss section 45, you're going to have to go and see a definition of group or group companies in section 1. It is defined there that one of the companies must be holding at least 70% of the other company. Okay, then you can say this is now the intergroup transaction, because intergroup transactions applies in group companies. And then the group companies means that the other one, that is the parent, must be holding at least 70% as defined in section 1. Otherwise, it is just that, it's the tax relief.
I love this. Sorry for this. I love this these different definitions, because they are important in now linking accounting and tax, where deferred tax comes up. Because we would have done our own stuff, intra-group transactions, at 51%, for example, because when we defined what a group is, in accounting, we looked at control and we agreed then this will be a holding company of the other one, and therefore we have a group, we'll give each other this release and this release. Now tax comes in to say, to us, a group is this, 70%. Nothing else. So then those deferred tax implications then pop up just as an integrated kind of thinking now, integrated level thinking between this tax and accounting. I'm terribly sorry, Mnumzane Mzwa, we've really run out of our time. I would like you to finish though. I'd like you to finish, because these points that you're mentioning here are quite important, and they do trigger in my mind some very important things to take note of. So I wouldn't want to rush you, but obviously this is at the discretion of the team. Please, guys, if you object to us continuing, you please do say, or you can jump off to do your other commitments. We are recording this session, so you can probably, if you need to do other stuff or you need to jump on to do something else, we can continue in a proper pace so that we can understand the core principles and the basic stuff that we need to understand here. Then what you can do is I'll try and make the recording available probably by 6 o'clock tomorrow, so that you can just quickly go to the end and listen to the remaining parts that he mentioned. I wouldn't want us to rush through this. So if you object, you can definitely either type it in the chat or just exit. But please do continue.
Okay.
Thanks, sir.
Okay, yeah, I'm just left with the 2 slides. I'm worried about the last one. I feel like the last one is going to be the longest, but it's fine. I'm just going to try to wrap everything up. Okay, and then another thing that you're going to be talking about is now the dividends tax. And dividends tax, well, it might look like it is tricky, but you have to relax your mind. Okay, and just remember, I think the one thing that you have to keep in mind is the definition of the dividend. Okay, that it excludes, what does it include, what does it does not include. Okay, because now you're going to be talking about now the contribution, the CTC. Oh, okay, so those you have to take out on the dividend that is paid out, if now they happen to form part of the dividends that is distributed. Okay, because these were the contributions made by the shareholders. Okay, it's just pure contributions. Okay, if now there was a share capitalization where now the company used the profit and then capitalized the profit on the shares and everything, that would not qualify as a CTC. Okay, it doesn't qualify. So if you are told to calculate the CTC, it is there. I think it would be the amount that was paid by the shareholder. And if there were some shares in, let's just say, preference shares that were converted from preference shares to now ordinary shares, you also include those, because those, they form part of CTC with the amount, the consideration that was paid for those shares. Anything else that was not paid for those shares, it is not part of CTC. And then you take out the CTC on your dividend before now you calculate your dividends tax. Okay, and then when you, so firstly you have to qualify it in the definition. If it does qualify in the definition, then you put it in. If it doesn't qualify under definition, then you take it out. Okay, the information is gonna say this on this dividend that is paid out, this certain amount was the CTC, then you take that out. Okay. Yeah, and also remember now, where if there is CTC, it's more like it's a disposal, then CGT is likely to come in. Please go and visit paragraph 19, where now they disregard the capital loss from the disposal of because remember there is like a deemed disposal on those shares that they now they paid dividend on, and there was like CTC relating to that. Okay, there's like a CGT triggered there. And then you have to take out the I mean, remember, you have to consider paragraph 19 when it talks about the ordinary dividends and the extraordinary dividends. Okay, just take note of that. Okay, and then when now you have a liquidation, I've just put on these debts to say that, okay, the first thing that you need to do is that you need to get the tax that needs to be paid. It's a liquidation, right? So they will be selling some asset, they will be, you know, doing this and that. So obviously there's gonna be, now they're liquidating, there's gonna be some assessed loss, then capital losses, you know, there's gonna be some recoupments, there's gonna be everything. So you need to calculate the tax on that company on liquidation. Okay, and then once you've done that, then you go and calculate the cash available, where now you bring in the consideration paid for those assets and the cash that was available and everything. You put it together, and then you take out now the amount that is not that is paid to SARS, which is the tax that you calculated initially, because your first step is calculate the tax, and then your second step is calculate the cash available. And then on the cash available, take out now the tax that is paid, take out now the liquidation expenses, okay, and then now you're left with the cash that is to be distributed to the shareholders. And before you do that, you have to remember, because now what you're trying to calculate is the dividends tax on the liquidation date. So now you're left with that amount after you've taken out the interest and the liquidation expenses. So you're left with that cash that is available to be distributed to the shareholders. On that cash that is available to be distributed, take out now the CTC, because it is not dividend. Remember, on the definition of the dividend, you have to take that one out, and then the amount that is left, it is the one that is going to be dividend. And remember who is liable for tax in terms of dividends tax, because remember, if now this is the dividend species, then the company is liable to pay dividends to SARS, and then if it's now just an ordinary dividend, then the person who's receiving the dividend is then liable to pay. Okay, and after that, you're going to be talking about the individuals. I think the other stuff that we were talking about, mostly it's involved, you know, companies, you know, the corporate persons. So here we're talking about now the natural person. Natural persons, you're going to be talking about the assessed losses. When now I'm a natural person, I'm a sole proprietor, I have this income from my employment, and also I have this income from the side business. Okay, then what happens if now I want to, you know, I have the assessed loss in one of these situations, very unlikely on the employment side. I have like the assessed loss on my business side, because remember, once you are a sole proprietor, your income from the business and the salaries, they get taxed together because you are one person, you're not a separate person. Then what happens if I make a loss on the business side? Does it get, you know, deducted on my those stuff? You know, when you're talking about the ring-fencing and everything, but that is under the individuals. Ring-fencing, if now it happens that making loss on the other side. But one thing that I always say, that the section 20 have like the requirements like the other sections, because firstly, what you gotta look at is that is the person on the maximum tax bracket? Because for reinforcing to apply, the person must be on the maximum tax bracket. If you are happy, it's a natural person is running a business, is on the maximum tax bracket, you're like, okay, reinforcing might apply to this person, because reinforcing doesn't apply to the company. Remember, it applies to the natural person. Okay. And then if the natural person is running this business, is making losses, you say, we can then deduct these. But wait, SARS is saying that, okay, out of the past 5 years, have you made losses in 3 of the 5 years? If it is the case and SARS says, no, I think you're cheating me. I think you are cheating, because what you are doing, you're making losses deliberately. So I'm not going to allow. That's when now the reinforcing comes in. And to say that, okay, I think this is a suspect trade. I'm not going to allow you to make these deductions, because you're trying to move from the maximum tax bracket. So it is those things. It goes like that. It has those steps. And then to say that, okay, it's not a suspect trade, I'm happy. Or maybe there's like a hope that your business is going to turn around and start making profits. Maybe I can allow you if there's hope you're going to start making profits in a certain point. Okay, that's how it goes. Section 20, I think it's cap A. The reinforcing section. To say, okay, if there's hope you're going to make income, so I might allow you. But let me look at the 10 years. Over the 10 years, in 5 of the 10 years, you've been making losses. You're not going to make any profit anymore. You know, I'm not allowing you to use the assessed loss from the business side on any of your other income not relating to that business. That's what happened. And then there's also like the retirement planning. Okay, remember, you include that on your gross income. Just when you do your calculation, I really advise you that, I mean, like, I think all of your lecturers have been advising you this, to not to include the amount of the retirement amount, the lump sums, or the any severance benefit on your tax calculation. Just create a separate column to say these are my lump sum, and then you include them, and then you do your deduction, whether in terms of paragraph 5 or section 10, I think it's section 10 cap C, not quite sure. But yeah, those deductions, you do them, and then you say, okay, if it's a calculate, if it's a calculate with the brief reasoning, you have to say that this amount are included in gross income in terms of this paragraph D of gross income, or paragraph C, depending on the nature of the amount. But when you do that, you need to also mention that this amount, however, are not taxable on the normal tax tables. They have their separate tax tables. They are taxed on the separate tax tables. There is a mark for that. You need to mention all those things. I think the reason you would not pass tax is because now you're missing these easy marks. There's like easy marks. It's not that you don't know tax, you know tax, but there's like easy marks that you're leaving out because you feel like these are obvious. Okay. And then obviously we include those amounts, and then in the end you have to take it out when you're doing your section 11 cap F, because that includes the retirement planning amounts and the severance benefits amount. Those are taken out. And also when you calculate your 27.5%, okay, that is like on a section 11 cap F, and if when you go to your rebates, you mean your medical aid credits, the 7.5% there doesn't also include that. I'm trying to think of something else, but in most cases they will be excluded. Those amounts would be taken out, and then you tax them on separate tax tables. Okay, remember how you go about doing the calculation. Okay, once, if you have received any lump sums before, then you say those lump sums that you received before plus the lump sums that you received in the current year, and then you calculate the tax on that amount. And then you say the tax that was paid on the lump sum that was received before. You take that tax, you subtract it against the tax that you calculated, including the current year lump sum. And then whatever tax you have remaining there is the tax that is payable. Okay. And then employees tax. Well, I feel like this is one of the chapters that you already know that is going to be there. Employees tax. You know someone is going to be employed. Whether this person is going to die during the year, whether was also going to this person, whatever happens, but there's going to be someone employed, because we need to test individuals, and to test individuals, you need someone with an income, and a person with an income is going to be employed, or would that person, maybe it's going to be a sole proprietor, but they're going to be receiving something, right? So if the person is employed, then you're talking about the fringe benefits. The fringe benefits, the right of use of a motor vehicle is likely to be there. There's like, I feel like there's like parts that you already know they're going to be there in that test. So you got to prepare for them. The moment you go in there, you prepare for them. Like the right of use of a motor vehicle. How do you deal with that? Because I do think that is like the part that is likely to be interesting when it comes to employees tax. The fringe benefits and the right of use of a motor vehicle, you know, the right to a primary residence to use and the allowances. Okay, obviously the right of use of a motor vehicle. I mean, sorry, the allowances in terms of, you know, the travel allowances. That's what I'm trying to say. The travel allowances, you are likely to have those. How do you now reduce those and so on? Okay, and the remuneration calculation. Remember the 80-20% rule. If in the allowances and the right of use of a motor vehicle, the travel allowance and the right of use of motor vehicle, if it is estimated that you're going to use the car 80% for business purposes, you include 20% of the value or of the allowance. And if it is estimated that you're going to use less than 80%, then you include 80% of the value or the allowance. I hope that makes sense. And then section 11 cap F, okay, might come in, the medical aid rebates. Remember the medical aid rebates, when you're doing your remuneration, the section 11, let me just start with the section 11 cap F. When you're doing a section 11 cap F, the employer, on the calculation of the remuneration, you wouldn't have now the taxable income on that 27.5%. What you're gonna have is the 27.5% of the remuneration, not the taxable income, because remember there's other incomes that are not included on that calculation that the employer wouldn't know about. Okay, so you just do the remuneration only, because it usually it is 27.5%. It is the lesser of 27.5%. I mean, it's a greater of 27.5%. Well, I'm not sure it's the lesser of the greater.
Yeah, I think it's higher off.
It's the higher off, ne? Yeah, yeah. Then you would have the two in calculating your taxable income, and then in your remuneration, then you would have one. Okay, and then the medical aid rebates, that is at the choice of the employer. If the employer chooses to do that, the rebates, because, you know, remember some of the expenditures the employer would not be aware of, so they wouldn't do that calculation. Okay. And then the provisional tax. Provisional tax, when you think about it, it would seem complicated. But I think the things that you have to be comfortable with before, you know, go into that exam on provisional tax. First of all, is the first provisional payment, when is it to be made? The second provisional payment, when is it to be made? Okay, and then the third provisional payment. But the third provisional payment depends on the two. Okay, and then now on the first provisional payment, you know, you don't have penalties there because you are required to use the basic amount. Okay, so you cannot underpay in that situation, because you are required to use the basic amount. Then now, depending when did you receive the basic amount? Did you receive the basic amount 14 days before the 31st of August or outside the 14 days? Because remember, if you receive it within the 14 days, you cannot use that one. You have to jump to another preceding year and not the latest preceding year to take that basic amount. And if it happens that now the basic amount that you're going to take is more than 18 months, then you know, okay, you're gonna have to increase that.
While you take a breather, I think I misled you there, Pete. It's actually the lesser off on that section. And I think it makes sense, because SARS would never give you the higher off for a deduction, eh?
Yeah,
so they will always
That's
want you to get the smallest that you can never get there. So lesser off, not higher off. My bad.
All right, thank you for confirming that for us. Yeah. on section 11A, it's gonna be you said it's a lesser, né? Yeah, it's a lesser or now of the remuneration, and it's a lesser of 27.5 of the remuneration or the taxable income. Okay, and then now you're gonna increase that. I'm trying to think of the percentage. That's why I was pausing there. The percentage that you increase it, it's just it's left my mind now. You increase that by, what is the percentage? I'm gonna get back to that. Let me just confirm it. Okay, but you're gonna have to increase that if it's more than 18 months. Okay, and then that's where now you calculate your first provisional tax payment. Okay, and then moving on to your second provisional payment, for you to avoid the penalties now, depending whether your income is below or above the million, but you must not pay something that is below 80% of the actual taxable income or 90% of the actual taxable income or the basic amount. I'm just making a summary of that. Okay, so those are the things that you need to be comfortable with on the provisional tax before you go to that exam. And if you are happy with that, because provisional tax is just around those things. Okay, and then now for a third payment to be made, it must be on a situation now you see that there is likely to be a penalty on the second provisional tax payment that you've made. And remember, when you're making your provisional tax payment, you take, because provisional tax is not a separate tax. It is just a mere advance payment to SARS. At year end, now you look at your actual taxable income and the amount that you've already paid on your provisional tax. And if it falls below the 80% or the 90% and as required, and all that situation, then now you know that for you to not to incur the penalties, you have to do a top-up payment. Okay, on top of what you already paid. That is when now the third provisional payment comes in. I think that is it on the provisional tax. I'm trying to confirm this. Yeah, I'm talking percentage. Employees tax is like yeah, I'm talking percentage. Otherwise, guys, on tax, if you write everything, because I do really believe that at this point,
yeah.
at this point,
Usianda just confirmed it's increased by 8%. Do you mind just, Sianda, just when you have a moment, though, no stress on this, okay, probably just write the section and the whatnot, where exactly do we find that, so that we can know it exactly on that. But I think on what you're saying, Mzwa, on writing a lot of stuff, Uspuso actually dropped a comment there 2013 saying, also just a reminder to back those easy marks when you need to discuss treatment of a certain transaction, like stating that it is a capital asset and SARS provides an allowance in terms of section 11E or section 12 cap C or section 1213, showing your CGT calculations clearly, so that if you miss one aspect in your calculation, you can still get the principal marks. I guess what it's saying now is, if, for example, you mistakenly added something that you should have deducted, or you mistakenly took a different amount, let's say it was 800,000, you mistakenly put in 80,000, you won't be penalized on that, because you said your reason of why, where did you get this 8,000, what exactly is this, so that even if you mistakenly punched in the calculator wrong, and as a result the final answer was wrong, or it wasn't in the memo, then at least we get those principal marks, huh?
Yeah, exactly. Thank you, Mr. Gazi. Thank you for addressing that. Yeah, discussing, your answers, just putting a brief description of what you are doing there would really help you and to get you those easy marks, because it's just this stuff that we feel like is obvious that we end up, losing marks on. Otherwise, taxi, and I'm pretty sure for you guys that you were able to get 45%, it means on Thursday you are going to get more than 50%. You just need to write everything, because it means it's not that you don't know tax, you do know tax. Let's just go there, attempt every question, allocate time in each of these questions, and make sure that you give a reasonable attempt in that question. in each of those questions, write for as long as you have time in that question, put something down. And you know, this year, I've had a privilege to be on the side of the marker. And I saw that, you know, when you are marking the script of the student, your mind is that, you know, you want to give this student a mark. So now the student falls at 48%, 49%. You see, you start to look where you can find the mark to, so that you can pass the student. So if the student is not written anything, you just don't know where to put the mark. You need to put something down, write something down. I'll read it. Okay, maybe it makes sense. I feel like there's sense in this. Put something down that, you know, makes some sense, so that I know, okay, you were trying to say this, you were trying to say this here, then you get a mark.
Yes, sir. Yes,
I really advise you on that, guys.
Yes, sir. And in as much as it is a privilege for you to sit on the side of the marker, it is a privilege for us to at least have someone here who will assist us on text. And this person does have a view of the marker. At least we know now in terms of our documentation or our answering in the script. Buti, ungumninganen.
Ndikujangazi situko ngapha eBizana
Mjangazi. Nkosi Mdram. Thank you so much, Buti, for this session. Thank you so much. And I know that Ngondo Zetu may have not necessarily focused throughout. That was me. At some point, I would literally run out. My brain would just freeze, but I would come back and I would remember where we are, and I'll try and learn at that point. And I think that was the case for our fellow colleagues as well. They may have lost their mind along the way, but they managed to try and keep together. Thank you so much for the precious time that you've put up. I do see this passion for taxation, and as academics, the tax, they're always passionate. And I guess it's because of the subject itself. All people that I've met who work in tax are very passionate about it. Thank you so much for your passion, Yako, and also for extending beyond the time that you had given us. Thank you so much to our wonderful colleagues as well. All the best for the tax exam. If you're joining us for MEF, we're having MEF tomorrow morning, 9:30 with Thusno Vuyo. She's also happy and ready to work with us. Hopefully everything will go well for us. The same link and everything is still the same. Mzwa, Danki Putiman. I think you're getting some love there on the chat. Yeah. Thank you so much for that. And Usianda just confirmed the 8% is actually the fourth schedule, paragraph 19.1. Gosa Putina.
Thank you. It was a pleasure to help. And thank you, guys. All the best on your upcoming supplementary exams. And I'm pretty sure you're gonna make it.